Today, we're diving into the world of bonds. Don't worry, it's not as scary as it sounds. In fact, think of it like this. Remember when you were a kid and you lent your friend $1? A bond is basically a fancy IOU for grown-ups, but instead of your friend, you're lending money to the government or a company. They promise to pay you back with interest. Let's say you buy a $100 bond. That $100 is like the loan you give. The issuer, the government or company, promises to pay you back in full when the bond matures. Think of the maturity date as the day your friend promises to return your dollar. Now here's the cool part. While you're waiting for your money to mature, you get paid interest, also known as coupon payments, at regular intervals, like every 6 months. It's like getting paid rent for lending out your money. Bonds are like the reliable friend in the investment world. They offer a steady stream of income, which makes them a great option for those looking for stability and predictability. This is especially true for folks nearing retirement or those who prefer a less bumpy ride than the stock market can offer. Think of it like this. Stocks are like roller coasters. They can be thrilling but also quite unpredictable. Bonds, on the other hand, are more like a leisurely train ride. They offer a smoother journey with fewer surprises, but that's not all. Bonds are also considered less risky than stocks, especially government bonds. Why? Because governments are generally considered less likely to default on their debts. This makes bonds a popular choice for investors who prioritize safety and capital preservation. Just like ice cream, bonds come in different flavors to suit different tastes. Let's take a look at some of the most popular types. First up, we have government bonds. These are issued by the government to fund its operations. They are considered the safest type of bond because, well, it's the government. Next, we have corporate bonds. These are issued by companies to raise capital for various purposes, like expanding their business or launching new products. Corporate bonds typically offer higher interest rates than government bonds, but they also carry more risk. Then there are municipal bonds, which are issued by state and local governments to fund public projects like schools, roads, and hospitals. These bonds often come with tax advantages, making them a popular choice for investors in higher tax brackets. Now, before you go all in on bonds, it's important to understand the risks involved. One of the biggest risks is interest rate risk. When interest rates rise, the value of existing bonds tends to fall. Think of it like this. If you bought a bond with a 3% interest rate and then interest rates rise to 4%, your bond becomes less attractive to other investors. Another risk is credit risk, which is the risk that the issuer of the bond may default on their debt. This is more common with corporate bonds, especially those issued by companies with a lower credit rating. Finally, there's inflation risk, which is the risk that the purchasing power of your investment will be eroded by inflation. This is a risk for all types of investments, but it can be particularly impactful for bonds, as they typically offer fixed interest payments. Bond yields and prices have an inverse relationship, meaning when one goes up, the other goes down. Think of it like a seesaw. When one side goes up, the other side goes down. The yield is the return you can expect to earn on a bond, expressed as a percentage of the bond's price. The price is what you pay for the bond in the market. For example, let's say you buy a bond with a $1,000 face value and a 5% coupon rate. If interest rates rise, the price of your bond may fall to $950. However, you'll still receive the $50 coupon payment each year, resulting in a higher yield because you bought the bond at a discount. Investing in bonds might seem complicated, but it's actually easier than you think. You can buy bonds through a broker or directly from the government through Treasury Direct. Remember to do your research, consider your investment goals and risk tolerance, and diversify your portfolio by investing in different types of bonds. Bonds can be a valuable addition to any well-rounded investment portfolio. They offer a balance of risk and return, providing steady income and the potential for growth.